Hello, I'm Andrew Cormack, Business Development Manager, Investment Solutions for Credo Wealth based in Johannesburg. As part of our ongoing commitment to clients, Credo is publishing a short series of useful free webcasts. These investment insight videos will address thematic issues within investing, rather than commenting on short-term market fluctuations. Our goal is for the investment insights to be as useful for you in 2021 or in 10 years' time as they are today. This is about investing through the cycle with a long-term view. Last week, Credo published the first of these webcasts with a look at phasing new funds into an investment portfolio. We continue by covering a related topic, that of rebalancing within existing portfolios. Your speaker will again be Ainsley Toe, Credo's head of multi-asset portfolios. These multi-asset portfolios are available on the My Credo platform and follow a systematic approach towards investing, in contrast to Credo's more well-known equity balanced and income solutions. There are 4 multi-asset portfolios available, each with a different set allocation to equities versus other asset classes such as fixed income and alternatives. Ainsley.
Thanks, Andrew. Rebalancing is a decision for investors already invested in risk assets. These are assets they want to be in because they believe their portfolio will have a positive long-term expected return. And we're going to compare 2 approaches here, periodic rebalancing and threshold rebalancing. So we'll start by defining these 2 strategies, and we're using again a 60-40 example, 60% equities, 40% bonds. What you see here is the equity allocation in a 60-40 portfolio. The y-axis is its weight in stocks relative to its target weight. So the target weight in this example is 60%. The green line is a buy and hold approach, so no rebalancing. The equity allocation moves around its target as asset prices move through time. Now, if we contrast that to the red line, which is a threshold rebalancing approach, you let the weights drift until they breach a predefined threshold, 3% in this case, and that's when you trade and you bring them back to the target weight. So on day 17 here of the first month, that's when the weight first moves 3% away from its target. There's a rebalance triggered at that first red dot. Then the weights drift again, this time to the upside, until they're 3% away from their target, at which point there's another rebalance triggered at that second red dot. So if that's threshold rebalancing, we're going to compare that to periodic rebalancing, which is the blue line here, and this is simply rebalancing based on the calendar. So you let weights drift until the end of the month, and that's on day 31 here. There's the first blue dot is when you trade back to the target weight. You let it drift again until the end of the second month, and that's when there's another rebalance triggered at that second blue dot. So why do investors need to rebalance? So what I'm showing here is the equity allocation, again in a 60-40 portfolio, for the 3 examples that we just went through. Now we're starting in 1962 here, and why are we doing that instead of the 1920s as we were in phasing? That's because we're using daily data instead of monthly data here, which there's a shorter history, and that's important, which I'll talk about later. So as we mentioned at the beginning, over the long term, equity returns have been higher than bond returns. So if you do nothing, as per the green line, the buy and hold approach, in this chart, equities grow as a part of your portfolio over time. And after 60 years, you have a portfolio that is nearly 90% in equities. Rebalancing, as with the other 2 lines, keeps our risk in line with our target. So that's why we need to rebalance. Now we're going to look at the long-term performance characteristics of different rebalancing strategies in a bit more detail. The green column there is the buy and hold, do nothing approach. Here I've added in orange a constant rebalancing portfolio. So this is just a hypothetical portfolio that trades every single day to maintain a constant asset allocation. We're going to add in blue here our periodic rebalancing strategies of different frequencies, so from monthly to annual rebalancing. And we're going to add in our threshold rebalancing strategies, and these are different trigger percentages, so from 1% to 5%. Now, the first thing to highlight is that returns over the last 60 years have been essentially the same for all of these portfolios. So this big picture comparison shows that the choice of rebalancing strategy hasn't made a difference from a pure return perspective. Now, if you look at the second and the third rows, you'll see that the volatilities and maximum drawdowns have all been similar, with the outlier being the buy and hold strategy, because this has increased in risk over time as equities have grown as a proportion of the portfolio. So to summarize that, with exception of doing nothing, risk and returns have been similar over the long term. Now, the last row in this table is the turnover. So intuitively, less frequent rebalancing, when we first refer to the periodic portfolios, you have experienced less turnover. That's because you're trading less often. If you're trading once a month for annually versus 12 times, once a year for annually versus 12 times a year for monthly. Similarly, looser thresholds have lower turnover, since you're letting the portfolio breathe more and you're trading less. An interesting parallel you may have noticed over this time period that we're looking at is that monthly rebalancing has roughly had the same turnover as 2% threshold rebalancing. Quarterly, the same as 3% threshold rebalancing, and annual rebalancing has roughly been the same as having a 5% threshold. However, this is just the big picture, and there are some nuances to all of this, which we'll go into in a moment. So I've shown you data from a long-term perspective to give you a big picture comparison of these different approaches, but the data spans many different environments, and it hides some important differences that are worth considering even for long-term investors who, some of which may not be so long-term at the moment in terms of their thinking. So here I've shown the average return on up and down days for US stocks since 1962. So over the long term, the average up day has been about 64 basis points, and the average down day about down 68 basis points. And just for comparison, I've also put some shorter periods. The fourth quarter of 2008, the market had daily up and down days of 3% on average. The year-to-date period, the last two bars on that chart, has been extreme, so up and down around 2%. But not quite at the 2008 levels on these measures anyway at the moment. Here is the same data for bonds. So though bond volatility has also expanded during certain crisis periods, as you can see here, the daily moves in equities obviously have increased a lot more. If you can see on this chart, which is using the same y-axis as the previous one, bond volatility has moved. But really the up and downs have not increased anywhere near as much as stocks. So because of these differences between stocks and bonds, this leads to variation in the way allocations change through time. And this is in contrast to the rebalancing strategies that we've spoken about, which are fixed. Periodic rebalancing, you're setting a frequency and you're leaving it over time with a long-term view. Similar with threshold rebalancing, which has a fixed trigger percentage. So what I'm going to do now is I'm going to dive into this a little bit further with some more time-sensitive data. So what I'm showing here is the US 60/40 portfolio over time, and I've got on the top left the number of trades that are happening for these different rebalancing strategies during any given year. And on the top right, we've got the range of equity weights that the portfolio goes through during those given years. So you've got the periodic rebalancing strategies, the top four, and the bottom four are the four different thresholds. And as you can see, if we scroll through time here, what you'll notice is that on the bottom is the equity volatility during these different years. And whilst I've shown you long-term average data for returns and turnover and risk, there's clear differences when you look at the year frequency in the number of trades and the range of equity weights that your portfolio is exposed to during the year, with some periods of very high volatility and low volatility, which ends up with different results. So if I just go back to 2008 as an example, what we see here is obviously this was a period of very high equity volatility, And if you start in the top left and you look at the number of trades that the threshold rebalancing strategies had to go through was extremely high. By definition, periodic rebalancing has a fixed number of trades every year. So this is one difference, is that with periodic rebalancing, you know the number of trades you're going to be doing, whereas with threshold rebalancing, it's more dependent on the environment. And in 2008, a 1% threshold rebalancing strategy had to trade 46 times during that year. The trade-off, if you look at the top right, in terms of the weights of your equity allocation within your portfolio, they're much tighter for threshold rebalancing strategies. So here your ranges are much tighter. Why? Because you're defining your rebalance based on your weights. Whereas with periodic strategies, the weight ranges are much more variable depending on the environment. If we look at a different year, so if we just look at 2017, which is an abnormally low volatility year, you can see here, whilst with periodic rebalancing, again, you had the same number of trades. Actually, in this year, threshold rebalancing had a really small number of trades because there wasn't so much volatility. But in terms of benefit, you didn't see much difference. When you look at the weight ranges here, they're very, very similar across the two types of rebalancing. And if we just have a quick look at year-to-date 2020, so we're just over a third of the way through the year, or just under, I should say, and already for threshold rebalancing, your number of trades are higher than periodic rebalancing, and we've still got some way to go to end the year. In terms of ranges, they have been slightly tighter, but with periodic rebalancing, you've seen as low as around 52-53% in your equity weight if you were at a 60-40. Whereas with threshold, you've managed to keep that between 55 and 65. Now, why did I highlight the erratic turnover here? It's because the returns I showed you previously were all before transaction costs. So for each investor, obviously they've got different sort of trading terms and different T costs, but that's something important to consider in terms of the trade-off here. A threshold rebalancing strategy gives you tighter weights, but it might impact your net return after transaction costs if you're going to be trading a lot, and obviously your T costs are going to be more volatile from year to year with threshold rebalancing. So something a bit more subtle, a more subtle issue with rebalancing is that it's in essence, rebalancing more frequently, I should say, in essence, it's a mean reversion strategy because you're trading against the price action in your assets. When your assets are underperforming or falling, they're becoming a smaller weight. So rebalancing is adding, you're buying assets that are falling, and when assets are rising and they're becoming a larger weight, you're selling, you're trading against the way the price is moving. Now, this is not normally an issue in quote unquote normal times, but there are periods when markets exhibit trending behavior, so they continue in a direction for a period of time. And if you're frequently trading, if you're frequently rebalancing against a trend, that can increase your losses during those periods. And that introduces negative convexity into your portfolio. So just to illustrate what that means a bit more clearly, what I show here are 12-month periods. Obviously, since 1960, it's the same data. For rebalancing strategies relative to lump sum investing and not, buy and hold investing. So the y-axis here is your relative performance of monthly rebalancing versus not rebalancing at all. The x-axis on this left-hand chart is the relative performance of stocks and bonds. So the left part of the chart is when stocks are dramatically underperforming bonds, and the right-hand side of the chart is when stocks are outperforming bonds. So you'll notice here that there's a negative skew to this chart. What that means is the periods in blue are when rebalancing outperforms buy and hold. And actually, when it outperforms by a small amount. The red dots are when rebalancing underperforms buy and hold. And you can see that these are much larger. They stretch much further on the chart. So you have when when rebalancing is outperforming, it's outperforming by a small amount. When it underperforms, it can underperform by a lot. The right-hand side of this chart is the preceding trend during these different periods. And if I highlight a couple on this chart, for example, this is end of February 2009, the 12 months ending Feb 2009. You can see that the preceding trend in the between stocks and bonds during those just before the rebalance date was extremely negative. Stocks were already underperforming bonds before we had to do this rebalance. And interestingly enough, the other worst periods for monthly rebalancing are all around the same time. This is December 2008, it's January 2009, so November 2008. So we can see is there's the trend was negative during that period for a long time, and that's actually all of these periods are overlapping. When the market's trending down and you're trading against it by rebalancing too frequently, you are incurring extra losses, and that's compounding your issue here, because this is a long only portfolio. So during these periods where stocks are underperforming bonds, your portfolio is also going to be losing money, and you're adding to that effect by rebalancing too frequently. So one thing you can do about this is you can condition your rebalancing strategy based on the preceding trend in the market. So I've got the same chart here on the left, but I've also included on the right here a different rebalancing approach, which is only rebalancing when there's no negative trend in the market. Otherwise, when there is, you're delaying your rebalancing and you're letting your weights drift. So what you can see is if we take this left tail, this conditional rebalancing strategy is actually reducing this left tail significantly and reducing the compounding effect that during underperformance for your portfolio, you're not adding to it by through your rebalancing. And also it retains the benefit of rebalancing, or some of it at least, in terms of these periods of outperformance during more normal times when there's no trends in the market. With phasing, as we mentioned, phasing is just taking risk later, and that's risk that you've already decided you want to take. So for most investors who are long-term in nature, lump sum investing has had better outcomes on average. However, investors who are more concerned with avoiding the worst case scenario could potentially consider phasing. On the rebalancing side, over the long term, and this is again the big picture, the exact rebalancing strategy hasn't been as important as having one. The outlier there was doing nothing. Threshold rebalancing tends to incur higher and less predictable turnover, but tends to keep allocations closer to target, which matters more during periods when asset prices are moving more. And there's for those who are focusing on more recent events, there's conditional information in that you can use during periods of market trends, for example, that can complement a long-term rebalancing strategy. So with that, I'll hand it over back to Andrew.
Thank you very much, Ainsley. There certainly is a parallel between gardening and investing. It's important to both know how and when to plant, but also, as Ainsley has demonstrated today, how to make changes that ensure maximum yields. It's certainly something that Ainsley puts to work in the multi-asset portfolios. As before, I'm going to ask Diane Gous, Credo's Chief Investment Officer, how the concept of rebalancing applies to Credo's discretionary managed solutions.
Thank you, Andrew. And let me begin by saying that I fully agree with the principles as espoused by Ainsley in that video. Having said that, when it comes to the practical implementation for most of our portfolios, we typically don't rebalance. And the reason for that simply relates to some of the operational issues that one encounters when you manage money practically. It's obviously worthwhile to rebalance in order to get back to a strategic asset allocation so that it can match with a risk profile. But one has to weigh that up with the transaction costs when it comes to trying to do this on a regular basis, especially for medium-sized clients. For very large clients, you can perhaps do so every now and then. But for smaller and medium-sized clients, one has to bear in mind the fact that rebalancing typically comes with a fairly large number of pretty small transactions on a regular basis. And when it comes to transaction costs, one has to realize that there are various elements to it, some of which boil down to fixed costs. And ultimately, we try and manage the portfolio turnover in all our portfolios because the costs are ultimately borne by the clients. It also affects performance, and we want to minimize that leakage in the portfolio. So what that means is that for the typical client portfolio of, say, a few £100,000 or so, up to even £1 million or $1 million, we will typically not rebalance very often unless it happens in the form of inflows or outflows where the client adds or withdraws from the account. When they add, one can add to the portions of the portfolio that are underweight and effectively achieve rebalancing in that manner. You can do the same when there's an outflow. You can withdraw from ones that are overweight. But when there's no inflow or outflow, as I say, and especially for smaller and medium-sized clients, we typically do not rebalance. This then does lead to the question, what happens over time if some of the assets in the portfolio perform much better than others? Surely the portfolio gets more and more out of whack, so to speak. And of course, the answer is yes. But in order to illustrate that it's less of a problem than what people may suspect, I want to mention the example of our best ideas portfolio, which now has a 9-year track record. And one of the best performances in this portfolio, probably the best one, is a stock like Microsoft, which we've owned since inception. So we've owned it for more than 9 years now. We bought it around $30 for clients at the time. Today it trades over $180, which means it's gone up 6-fold in a 9-year period. But the point that it's gone up 6-fold in a 9-year period doesn't mean that today it's 6 times as heavy in the portfolio as some of the other stocks in the portfolio. Because bear in mind, the whole market's up and most of the other stocks are up some multiple as well. Perhaps not 6 times, but they're all up strongly. So if we look at some of those portfolios today, best ideas portfolios with a long-term track record with Credo, practical ones of real clients, you may note that, yes, Microsoft is likely, very likely, to be the heaviest weighting in that portfolio, but they may be of the order of twice as big in the portfolio as the smallest stock, not six times as large. So yes, you do get some sort of reweighting over time, which is a function of drift, if you like. But it also means that while we remain happy with a stock like Microsoft, and we certainly think that it remains a blue chip and a core holding for the medium and longer term going forward, to the extent that that investment thesis plays out, the client gets the benefit that the stock, which is arguably one of the highest quality stocks in his portfolio, his or her portfolio, will give more performance because it is now at a heavier weight than it used to be. I want to emphasize what I said right at the beginning. Rebalancing is important to the extent that it keeps a portfolio in line with a strategic asset allocation and therefore a risk classification of a client. But small amounts of drift, ultimately from a practical point of view, we think we can live with. And ultimately, the benefit that one gets in that manner is that you save on transaction costs. And that's why we do it in this way.
Thank you, Dion, and thank you, Ainsley. As before, this video will be distributed and made available on the Credo website. If you have any further questions or would like additional information, please contact me, your relationship manager, or Credo Client Services. You will find our contact details here and also on our website, www.credogroup.com. We hope to have the next installment in the Investment Insight series with you soon. In the meanwhile, please stay safe and remember, when you think of investing, think of Credo. Thank you and goodbye.